I'm going to share then this video with you, which is about then chapter 11, budgeting. It's quite a long chapter, but I'll try then to summarize in the theory as much as I can, because the focus will be on how then to do the calculations. But the theory is also important because remember, especially now, the way then we are taking on the assessment using the multiple choice and your true or false. So most of the questions came out of the theory. So it's very important also then to make sure that the theory part of it, then you also familiarize yourself with. So I'm going to start then to open up then the PowerPoint presentation and share then with you after the budgeting. Okay, this is then the chapter 11. That is our second last chapter. So very soon then I will be done with our 2020 syllabus. So these are the specific outcomes out of this chapter, is to prepare a master budget, which is what we're going to focus on. On our syllabus, we will pay attention then to the master budget. Then a cash budget is not part of our budgeting, and projected financial statement is not part of our budgeting. Then as well, now we will do then the flexible budget is going to be part of our reporting. So then the only two budgets that are not going to be part is a cash budget and your financial statements. So we'll do then the master budget and your flexible budget with a performance report. So at the end of this chapter, these are the budget that you'll be familiar with. So don't mind about the criteria. Now let's look then at the budget. But what are we talking about when we talk about the budget? They say here a budget is a future plan or a map helping a business to achieve its desired goal. That is so true. So that's where then we draw up our plans, or then we pave a way. Okay, this is the direction that we want to take as an organization. Also, a budget is an operational plan set for a certain period, is a proposed future plan of action, identify the resources required, identifies commitments required. But on our side, then I will pay more focus than on the operational side, because when we talk about then the future and everything and the resources, then is something then that has nothing to do with calculations. Hence, then in our syllabus, and we just pay then attention then on the calculation side of things. So they explain to you then about the future plans, and it involves then your financial aspects. You'll pay attention and read those then, and also what's the purpose? Why then we draw up the budget? We draw then the budget so that we can do then the planning, and also we can control then the activities, or then whatever then work then that we are doing in the organization. These are the budgets then that we are talking about. I've already mentioned that to you. Then I will pay attention then to the two, but then this one then is not going to be part of our syllabus. So we look at the fixed budget, flexible budget only, not then the cash budget. Why then do we prepare then the budget? We did mention that it assists then in planning, and also then to coordinate then activities within the various departments of the organization. Through the budget, we can also communicate then the plans then across then the department. Remember, then once you budget that this is what you want to achieve, if then you fail or you've done more than what you've planned, then that means then you can use the budget as well also then to motivate then the staff. Sometimes then you need then to reprimand. The budget can also help you. By doing so, then we are controlling then your activities, as well as evaluating then the performance of the managers and the workers. Because you can imagine, if then you say that you are going to evaluate what the workers done, you are basing that on what? If then you don't have a plan or the budget. Then they explain then to you about the planning, what the major planning decision will already have been made as part of the organization long-term planning. Hence, any organization will find that they've got their vision and mission. So that then revolve around then the budget as well. Then you can do the coordination where you reconcile then the activities of the organization and you communicate then those results then to everyone involved within the organization. That's what then they are talking about. We've also touched then the issue then of motivating then the staff, also then the managers through then what we've achieved then in reality based on what we've budgeted. We can take then the controls. You can say that, okay, you thought that then you are going to spend then 20 million on your material, but it was 15 million. Then you can adjust and shift then those funds then to the other side. So then it helps you then on that. Guys, then you could say then that I don't pay much attention then to these details then at your own time, because you've got these slides also then on your file. If you can check then on your files, then you'll see then these slides, and you can just go through and familiarize yourselves with all what is being said here. Performance evaluation, we've said again that the performance, because even in other organizations, even then to get the bonuses in the companies, and that is based on the performance of then the workers. So that is carried out through then the plan or the budget that is being done in the organization. Some good advantages of then drafting then the budget. It provides then a meaningful way then to communicate then the plans of the organization, forces also the managers then to think about the plans in the future, and also it serves as a framework of what is going to be done in the organization and so forth. And on the other side, there are disadvantages. You can spend a lot of time then planning and doing everything, but at the end of the day, when you look at the actual results, they are not talking to what you've planned. So basically, you've wasted your time and some other disadvantages. Then 11.6, how do we prepare budget? Small companies usually a simple informal process take a few days or hours then to complete, but in a large organization, then a lot of time is being spent looking at number of procedures, then to scaffold then the budget, and that can take several months then to complete that budget. Then obviously that is done by the top managers doing those budget, where we talk of the budget committees and so on within the organization. What's the period? It depends. Again, when it comes to the period, we can draft the budget for a week, for days, for a month, or for a number of years, or then doing it quarterly. So even on the exercises, guys, and you look at that particular exercise at that moment, and you'll see that, okay, this budget is drawn then for a week or a month or whatever period that will be given then to you. Then you've got also then the guidelines that you have then to draw up then the budget. They are given then for you, the initial budget proposal and all those things, external factors that needs then to be in place. Then you negotiate then with the departments, with other managers and everyone else then who is going then to be involved in that budget. I mean, there's a quite a lot of information that they are talking about. But I think then from here, 11.7, the master budget, that's where then we will start then to be involved as cost accountants. The master budget stays the same when the volume or activity change. So that's what then we need then to take note of that. It stays the same. In other words, then this is a fixed, hence then we say as a static or a fixed budget. So it has nothing then to do with the volume or activity of the organization. If then we set that master budget, it stays the same. The master budget then is a summary of financial projection contained in all the individual budget of the organization. Consists of the two sets of budget, operating budget and the financial budget. Remember what we said about financial budget is not part of our syllabus, so we will look at the operational side of things when we draw up then this budget. And when we talk of then the operating budget, it consists of the following budget. You talk of your sales budget, production budget, direct material, direct labor, manufacturing overheads, cost of goods sold, and other non-production costs. So you could see then this budget is like then we start then with the sales, that is your completed units. Then once you said, okay, now this is a target of then my sales. Now the next question will be, are you going to be able then to produce then the target? So to answer that question, you need then to go to your production budget. So and look at your production budget in terms of the capacity that needed then to be manufactured in order then to meet our sales target. So we spread again then the production, because once we talk of a production, we are talking then about these three elements. We talk then of your material, labor, and your overheads. Then you need then to go and check then at your material. But how much are you going then to purchase your material? What is your usage? And also then your labor and manufacturing overheads. Then you look at the cost of sales, and that's after you've completed then your production. So that's how it goes. And now the master budget, your financial side, capital budget, cash budget, your budgeted statement of comprehensive income, and your statement of financial position. Those are the budgets then that they have drawn there. Now coming back then to our master budget. So it covers the following: operating decision, which deals with obtaining and using scarce resource, that is your material, labor, and the equipment. Financing decision, which deals with how to get the funds required for the resources. But for us is to do the calculation and say that now this is not the amount that is being needed, then the managers will take the decision. We don't advise the managers, okay, do this in order then to source out the funds. The term master means that the master budget is an all-inclusive or organizational-wide set of budgets. So everything is there. An example then of the master budget is given in figure 11.1. Let's look at that. So this is then the demonstration of your master budget. So as we've said that we divide into two, you've got your operational budget, you've got your financial budget. So it will depend again at your term. You can draw it then for a short term or your long term. Then I will have then your sales budget there, followed by production. Hence, I was saying then to you, once you've got your targeted sales, then you need to ask your question, okay, do I have enough capacity then to produce what then I've desired then to be my sales? And you look at your production budget, that will take you down then to these three elements of your production. Then you look at your cost of sales. That is the last one on your operational budget. Then after that, it will take you out then to the financial side of doing then or drawing up then your budget. Right, let's look at our sales forecast. So this is what they've said about the sales. Preparation of the master budget usually starts at the sales forecast. Accuracy of the sales forecast is critical because it is the data source of all the other budgets. So it means that once then you've done something wrong in this budget, it's going to spoil everything. Everything is going to be wrong. By the time then we use then to conduct then the face-to-face, so it was a challenge because I used then to tell the student that, look guys, once then you've messed up then with your sales budget, now you can expect zero. But now we go then a multiple choice and you can source out then the answers from somewhere and do all those things. Accuracy then is the key anyway on your sales budget, done using then a statistical techniques, quantitative method, or it can simply be subjected to a professional judgment of sales manager and senior management. So we don't want them to go there. There was a chapter then that was talking about that, but they've decided also then to take it out of our syllabus. It was about those techniques, okay, how do we determine then the number of units then to be sold and everything. Now preparing this master budget, example 11.1 will be used to illustrate the operational as well as the financial budget. So hence you see myself guys and just going through then the theory, because I knew that when it comes to this budget, so each and every budget we are going to explain it, okay, who's responsible to do it, what is all about. So it will be really a waste of our time to keep on explaining then to you, okay, this is a budget commit and what. So you need then to read those things and when you are about to take the assessment. Now let's look at this sales budget. The sales budget is a starting point in preparing the master budget. All other items in the master budget, including production, purchasing, inventory, and expenses, depend on the accuracy of the sales budget. So we'll look at this example 11.1. I've tried then to attach then this example. I hope then you'll be able then to see this, but if not, then please go to your textbook to that page 256. You will see then this example 11.1. Then it reads, Stitches Limited, owned and managed by Suzy, manufactures and machine knitted cotton tops for summer and hand knitted woolen jersey for winter. An extract of the statement of financial position on the 31st December 20x7 is given below. So you've got that extract of your financial statement. Account payable are utilities payable by the 7th of the following month. A cotton top requires 400 grams of cotton yarn purchased at 50 Rand per kg, and each jersey requires 1 kilogram of wool purchased at 100 Rand per kilogram. Materials are purchased for cash. Suzy has 4 employees. One employee earning 120 per hour knits the cotton top on the knitting machine purchased in January 20x7 for 21,000. 3 knitters are responsible for the woolen jersey earning 130 Rand per hour. It takes approximately 24 minutes to complete a top and 1.5 hours to complete a jersey. Completed top are sold at 200 Rand each and jerseys are sold at 400 Rand each. Currently, Suzy sells to one boutique on credit. The terms are 30 days net. Suzy was approached by a chain of clothing stores to supply them with 200 jerseys per month from April to June 20x8. The terms will also be 30 days net. Julia, one of 3 hand knitters, told Suzy that she could triple their output if Suzy purchased a knitting machine suitable for the thicker wool that they are using. A jersey can then be completed in 30 minutes. Jerseys not taken up by debtors can be sold for cash, as several other boutiques have made inquiries about their products. Cash sales of jerseys are estimated to take place even from April to July, 100 jerseys each month. This will increase the projected sales to 1,100 jerseys for 20x8. Take note of that. So they made inquiries and found that she could purchase a machine for 30,750 paid in 4 installments without having to pay any finance charges. So the plan to purchase the machine in January 20x8 to make sure that Julia will master the use of the machine in good time. All equipment will be depreciated over 3 years using the straight line method. Credit sales are expected to take place as follows. So they start from October 20x7, you put in your cotton tops and your woolen jersey, you've got the information there. Budgeted inventory level, you've got your opening and your closing, completed tops, completed jerseys, wool, and your cotton yarn. That is now your raw material. Variable manufacturing overheads are allocated at 40 Rand per direct labor hour. Fixed overheads are 12,000 per month at normal capacity. This includes depreciation of the equipment. Selling and administrative cost amounts to 1% of sales. Complete the following for the year ending 31st December 20x8. So it means that it's going to start from 1st January 20x8. So you are required then to do then the sales budget up to projected statement of comprehensive income. But remember, we said that we stop only now on number 8, that is cost of sales budget. So those are the budget that we only pay attention to. All right, now let's look at the first budget, our sales budget. They say to us, the sales budget shows the quantity. Now take note of that. what we show then on the sales budget: quantities, the intended selling price of each product, and the total predicted sales revenue. So we combine now the units and the selling price then to arrive then to our sales amount. So look then at the solution there of the question. You've got your tops and your jerseys. Now you're going to open up then the columns and with your finished product, because we're talking about sales here. You can have then the total column if you liked. Then a projected sales units is 700 and 1,100 times the selling price 200 and 240 there. Now let's go down, guys, and verify then these units from now the question about how did you arrive then to these units, so that we can see that we can prove. Let's start then with the cotton top. Then we, from the cotton top, then remember then our financial year starts here. So you take then your 20 plus the 20, then another 120, 120, 120 is 116 October, and you've got 80 and 60 there. So then they will give you then this total of 700 rands. But then I come then to then the next month, your woolen jersey. If you follow then the same way of calculating, you'll take then 100, that is in March, then plus then 300 in April, plus again another 300 next month, plus then you 350 plus 50. Then you'll see then the 1,100. So there is a 1,100. Or another way then of looking now the quantity then for the woolen jersey. If you come then to this page 257, we were told here that this will increase the projected sales to 1,100 jerseys for 20 times 8. Those then who are still using then the second edition of our textbook, that's the only way then to find out then that 1,100. But then in this third edition, they've also add then the quantities here to arrive then to the amount. So then we are happy with the units, and again then we were given then the selling price. The selling price, we were told that then completed tops are sold at 200 and your woolen jerseys is 400. So no problem about that. So we can happily then draw then our sales budget. So 700 by 200, 140,000, 1,100 by 400, 440,000. So that's it. That's easy like that then to draw up then your sales budget. Now we move on then to the next budget. The question then on this budget, now that we've got this projected, guys, we've got this 700, this 1,100. The question is now, do we have then the capacity to manufacture or to meet then that target? That's what is being addressed then in the production budget. Then they say the production budget is the responsibility of the production manager. That makes sense because this is what takes place then now. The production expressed in quantities only. Take note of that. We don't have then the rand values there. It's only the quantities when it comes then to that budget. Then the objective is to ensure that the production is sufficient to meet then the sales demand. That's what we're talking about. Now we've got 700 and 1,100. Do we have then the capacity then to manufacture those units? And also then another objective is that sufficient inventory levels are maintained for future sales because in the budget then excuse me, they can draw there over we want them to have then the closing balance and at what level. So we need also then to check that can we be able then to meet that. Then again, at the production budget, start with the projected sales units that were used in the sales budget and not sales value. Why we say that not sales value? Remember, we said that then is only quantity. So we can't have then the sales value yet. We're talking about quantity. Then the production units will now be used to compile the material budget, labor, and manufacturing overhead. So we use then the production budget. Now that then the sales budget was the base then for our production budget, the production budget also serves as the starting point for the other three budgets. So let's look at our production budget. Here's then the solution of your production budget. We started again with the projected sales units. Remember to take then the quantity. We simply then add the closing inventory. Why we add the closing inventory is because it's what we've manufactured currently. So the units required is 720, 1,108. But we know that then in this 720 there is an opening because we started from the sales. So we say let's take out then the openings and we left with 710. That is what we supposed to manufacture in order then to be able then to have this sales rate sitting at 700 units and on this side 1,100 units. So we need to manufacture on this side 1,140. I hope then that makes sense to everyone. And we say that now this production requirement is going to serve as your base then for the next three budgets, because then we say this is a production. Again, I look at the production, look at our headings, and we name then our columns with the finished products, because then once we talk of the production, that's your working process, so to speak. That's where we look at what we've produced, the name of the products. But you'll see now the change when we go then to the material budget, because we talk of the material. Now we spot then the difference on our naming of the columns. So let's start then with our direct material budget. So we look at what they call it direct material usage budget. It shows the quantity of raw material that is okay, sorry for that. So we said that then this direct material usage budget, it shows the quantity of raw material, that is direct materials required for our production. Then at the last line of the production budget, then is going to serve as or become now the first line of the material usage budget. Required production is multiplied with the quantity of raw material needed for the production of 1 unit of product to determine the total quantity of raw material needed for production. So what this bullet point mean to us, guys, then is this. Because we know that, okay, we've got 1 unit. Now the question is, what is the usage now of the raw material to manufacture then that 1 unit? How many kilograms, if we're talking about kilograms, then to manufacture 1 product? So we will look at that. Again, then once this quantity has been determined, the raw material purchase budget can be completed. So then these are the things then first then that you need then to do before you can complete then your budget. Again, direct material purchase budget often combined with the direct material usage budget, because then when you talk of purchases, what is your usage simply multiplied then by your material price, where they say the production supervisors will prepare estimates of the material required to meet the production budget. Sorry. The responsibility for obtaining the planned quantity of raw materials to meet production requirements is that of the production manager. The objective is to purchase these materials at the right time at the planned purchase price. Then it also takes into account the planned raw material inventory level, identifies the total purchases to ensure the availability of sufficient direct material for production and ending inventory to start production in the next period. The quantity of raw material to be purchased multiplied by the expected cost per unit of raw material determines the amount then of purchases. The raw material budget for the year will be as shown in this following table. So this is then the solution. Now looking at that question that we have here, so this is the solution. Let's look then at the differences then that we've talked about. Now first look at our columns again. It's going to be a 2-column statement. We've got then the cotton here and the wool. It's no longer now what used then to be, because before then we talk of then the tops here, and here it was your jerseys. But because now this is now the raw material, we've removed then this and said the best way. Let's look then to make then this top. What do we use? And the answer was that then we use then the cotton, and also then to come up then with the jersey, then we use then the wool. So that's why then we've opened up then the columns then like that. All right, so we've got the cotton here and your wool. Again, remember we said that what is your ending in your production budget is going to be then the starting point in this budget. Hence, then we start again with the production required, 710 units, 1,140 units. Now we said these are the units. Or the completed items. So if then we say that these are the units, before we can do anything, we need to convert them back then to the raw material. So the question is, if then in your top then you've got 710, what material then do we use, and how much then it takes then to produce 1 unit there? I'm trying then to go back to the question so that we can see that what we're talking about. Here we are. Oh, sorry. All right. This is another question. Look at then this paragraph on page 257. A cotton top requires 400 grams of cotton yarn purchased at 50 Rand per kg, and each jersey requires 1 kilogram of wool that is purchased at 100 Rand per kg. So then that's the information that we're looking for. Oh, okay. To produce one top, it takes us 400 grams. And we need then to express then the information according to the kgs. So you simply ask yourself, okay, therefore then how many kgs in this 710 that I have? And the only way then to be able to know then the number of kgs then that you have in this 710 is to multiply then by the required kgs per unit. So we've converted then 400 grams, because saying 400 divided by your 1,000, then it gives another 0.4. 1 kg, you divide it by 1 is a kg anyway, what we are looking for. There's no need then to do any calculation, it's just to take that as it is. There, and we say then multiply this, and then your material. Now the material required is 284, and this side is 1,140. Now we can, again, as we did then in the production budget, add your closing inventory, you take out your opening, then this is then your purchase in kgs that you need. And you simply do then your direct material purchase budget by multiplying by your purchase price. We were told that is 50 Rand and 100 Rand per cotton yarn here, and also then the wool. 1 kilogram of wool. So then this is then the amount. So this is how then you draw. It's a little bit complicated. You need then to be alert when you draw up then this direct material budget. But if then you are, then you can be able to pull it easily and do it. All right, then we move on then to the next budget, which is the direct labor budget. The production budget serves as a base then for preparing the direct labor budget, same as your direct material budget. Direct labor requirements must be determined then to determine whether sufficient labor time is available then to meet production needs and to eliminate labor shortages. Same as then your material, because in material we say that we look then whether then do we have a sufficient raw material to be able then to produce or to complete the units. And again here then are we going to have then the sufficient labor time then to be able then to meet this 700 and 1100. The direct labor budget is the responsibility of the production manager or managers of different departments who will prepare estimates of the labor hours required to meet then the planned production. Different grades then of labor should be specified separately in the budget, because then you can have then quite grades then of your labor, starting then from those who are so unskilled up until then your skilled labor, so they are going then to earn differently, and also the time that they are going to take then in the production is also different. We need those specification. The budget rate per hour should be determined by the industrial relations department or the human resource department. Once the total direct labor hours required and the budgeted rate per hour has been established, the total direct labor cost for the period can be determined. Sorry. Then this is then our total, our solution for the direct labor budget. Again, we go back then to the products when it comes then to name then our columns. So we go back then to our tops and jerseys. And we say that the production required 710 tops and 1,140 jerseys as per your production requirements. Simply multiply that then with your labor hours per unit, because if you can go and check, guys, then on that page 257, when it comes then to the time, that's where you'll see then at this time then that is being allocated there, because we were told that then it takes approximately 24 minutes to complete then a top, and 1 hour 30 minutes and 1 hour then 1 hour 30 minutes to complete then a jersey. Then I will have then to look then at that time then and do then our calculation. So as they've explained or they've done now also for us, and the calculation here of this time is, remember the labor time for jersey is now only 1/3. It's no longer of then that 1.5 hours, since then the new knitting machine has been purchased. Therefore 30 minutes or 0.5 time that is being used here. Then time to produce then the top is 0.4 hours or 24. Then you divide that by, then that's the 60, because they said it approximately take then 24 minutes, and you've got 60 minutes in an hour. Then it gives you then this 0.4. Then it takes you then to this 284 and 570 on the other side, and you multiply it by the direct labor rate per hour, because you've managed to convert then the production required then to the hours. And you multiply that, and you say then this is the number of hours then I will need, and this is going to cost us so much. Then you'll see whether then you've got then the capacity then to cater for that. That's your labor budget. Then the next budget is your manufacturing overheads. The fixed overheads budget includes all production costs other than direct material and direct labor. The manufacturing overheads budget is usually separated into fixed and a variable item. Variable overheads vary in direct proportion to the number of units manufactured, or then you'll use then whatever base then that is given then to you. All manufacturing overheads costs that do not vary in direct proportion to the number of units manufactured are treated as then your fixed cost. The manufacturing overheads rate per unit is determined by dividing the expected total manufacturing overheads by the projected or normal production for the budgeted period. It's not always then the case. Hence, I was saying to you, it will depend on what base is given then to you. then you'll get then your variable overhead rate. Then you add then your fixed overheads. If then you want to work out the rate, you simply divide by your budgeted capacity, and you can have then that. Now look at the solution that we have then for our manufacturing overhead. Again, then we haven't changed then names then in our columns. We use then at the top, you'll see then Y. Production required again. Then you'll see then the direct labor hours per unit. You may question that, but why now we take then the direct labor hours? Yet then we're doing then the manufacturing overheads. If you can look on page 258, then just below then are your budgeted inventory levels. You were told that variable manufacturing overheads are allocated at 40 rand per direct labor hour. Then that automatically tells us, well, okay, we are using the labor hours to absorb the overheads in the production. Hence, we're using then those labor hours. So again, it's going to be then that 0.4 and 0.5 there, and you multiply then by 40, which is then your overhead rate that is given then to you. So you'll use then that rate as provided. Oops, I'm sorry, I don't know what's happened. I just jumped out of my presentation. Then it will give then this. Oops, sorry. Okay, sorry for that. Then we look at this solution. So then these are the amounts that we've manufactured. Then in total, it gives us 34,160. Then you can simply add your fixed overheads cost, which is 12,000, because we were told also then it's 12,000 per month. And we've noticed that this budget, we are doing it then for a year. Hence, then the question says that then let's do it for a year ending 31st December 20 times 8. That is why then we multiply by 12, and it gives us this 144,000. And you've got the total there. So that's how then you prepare then this budget. I hope then that is clear then so far. And I'm sure then you want then to test yourself then if then you've managed then to understand all what I was being saying then to you. So then to do so, I will ask then to you then to do then on the question 2, page 277, please prepare 11.1 there. And you also prepare 11.1b, 11.1c, 11.1d. Also 11.1e up to 11.1f. So please then just quickly do those exercises. I'm sure you are going to enjoy it. We are going to end our sessions and our today's session here. So next time then I will start then looking at the solution of then those questions 11.1 and see if then we've managed to grasp what we've talked about. And after that, we'll carry on up until we finish then the budget that we're going to do then this syllabus. Thank you very much. I hope then you'll enjoy then this video and everything then I will make sense and a little bit, I hope.